the environment really, really does look like it's a business cycle expansion. You look at the breadth of consumer spending, if you aggregate all of the sectors that go into the personal consumption expenditures basket, about 90% of those sectors are actually expanding, right? Which is, again, entirely inconsistent with any type of material slowing. What we think that weakness in the labor market is coming from is coming from slowing immigration.
And a huge driver of that, I assume, was illegal immigration.
A really, really big part of it.
Yeah.
We're definitely in a unique spot, which we haven't experienced really in history before.
This episode of Monetary Matters is brought to you by VanEck's semiconductor ETF, ticker SMH. As you may know, SMH is the largest semiconductor ETF by AUM, with over $25 billion in assets under management. But what you might not know is that SMH has historically outperformed its largest competitor, SOXX. In addition to SMH, VanEck has launched SMHX, a first-to-market fabless semiconductor ETF that's been intelligently designed to capture low capex, high-margin chip designers, setting the next stage of AI. You'll hear more about both later in the show. Let's get into it. I'm here once again with Aahan Menon, founder and CEO of Prometheus Macro. Aahan is a true quant, and he can include among his clients some of the biggest and most sophisticated hedge funds and investors in the world. Aahan, really great to get you back on Monetary Matters. Good to see you.
Jack, great to be back. Always good to see you.
Aahan, how would you characterize the current business cycle we're in right now?
In one word, an expansion. To wind back a little bit, I think there were a lot of concerns around the start of the year around the effects of tariffs and what that would do to the economy. I think as we've kind of progressed through the year, it's become evident both through the de-escalation of tariffs and the actual mechanical impact of tariffs that they wouldn't be such a big deal in terms of their impact on the economy. And so I think when we take a step back and really look at where we are, the consumer still seems fairly strong. Spending seems relatively robust. Businesses continue to invest. We've actually seen a modest uptick in business investment as well recently. And so I think as long as we have investment ongoing, consumer spending ongoing, and we don't have very negative financial conditions, you continue to remain in a business cycle expansion, which is where we've been for a while.
What is powering the business cycle expansion? In 2021 and 2022, it was kind of obvious. It was the very strong labor market. It was the exceptional levels of nominal growth in spending. I mean, double-digit growth in nominal spending at some points in 2021, kind of unheard of. What is powering the business cycle right now?
I think some changes in the way the business cycle has worked are really kind of showing up in this particular expansion. I think the biggest change that we've had is that, over the last 60 to 80 years, the business cycle was dominated by manufacturing and industrial activity. But as we entered the 2000s, we've had a shift where intellectual property and information investment have become a really, really central part of how businesses invest. And that investment has largely been very, very stable. That coupled with pretty resilient spending from the consumer on non-cyclical items, things like healthcare and, things that typically don't cycle very much with interest rates, have resulted in pretty stable levels of spending, which translate into corporate revenues, which have been supporting corporate profits. And so I think the big shift that's really occurred over the last few decades is basically you have what, for lack of a more concise way to put it, the technology spending really, really just supporting a lot of the economy, both in terms of investment and consumption. And that is really like the center of what's been supporting this business cycle.
And I wonder, Aahan, because as you know, there's a huge disconnect between the economic data, which points to a business expansion and an overall, strong-ish economy, and the sentiment out there, which is just very, very negative. And I wonder, is it that the sector is receiving a lot of investment and therefore probably a growth in employment and compensation definitely is technology, which is not by definition, but it is a sector that employs a relatively small percentage of the population as opposed to so much else in the economy.
Yeah, that's absolutely true. And, distribution is not the same as the aggregate, right? And so what we have is a situation where the aggregate economy looks fine. But what we have is very, very concentrated kind of gains, right? So you have the tech sector and tech employees. In fact, depending on how you aggregate it, you could actually make the case that information and tech related employment has actually been modestly declining,
Mm-hmm.
but still the amount of spending that's going on in the sector continues to expand very rapidly. And so, yeah, I think that that's 100% true that, when you look across all the sectors, are they all extremely strong? No. But what we do have is a concentrated economy, and that concentrated economy reflects itself in an aggregate which is relatively stable.
And Aahan, you had 4 charts on business cycle investment. I was looking among those 4 charts for something specifically about technology capex and AI capital expenditure in particular, like NVIDIA GPUs and the like. You did have a tech and intellectual property uh, investment chart, but it wasn't as high as I would have thought. Can you explain that? Because something that and I haven't run the numbers as a percentage of GDP, but I've just been looking at where the growth is in spending in the economy, and it quite clearly is in artificial intelligence capital expenditures, most of which are a slight half or slightly higher than half, I think, has gone to literally one company, NVIDIA. But when you're looking at real investment in intellectual property, it's only 50 basis points of GDP you have for intellectual property, which is lower than it was in a lot of the 1990s. So is this maybe not as big? Because I saw one, basically blogger but economic thinker, equate the AI capex to 1% of GDP, but you have all intellectual property contributing in real terms as less than 50 basis points of GDP.
What that number really is basically we take all of the data related to intellectual property investment, right, and information processing equipment investment. We create now costs for those based on timely reads that are available from monthly data. And what we're trying to do is we're basically trying to create an attribution to the current level of growth, right? And so if we're saying that we have 40 basis points of this AI capex related information processing related spending, that's on a headline real GDP number of 1.4%, right? That's actually a very, very large fraction of the growth.
Oh, sorry. So it's not 50 basis. It's 50 basis points of 1.4%
Yes.
is like 30%. Okay, yeah,
That's a very big deal.
yeah.
So, when you look at it from that perspective, when you actually zoom out and say, hey, like, how big is this complex relative to the rest of the economy? Um, it's, I don't want to quote a number off the top of my head because I don't remember it. But basically, when you look at the contribution to growth, which is what I described just now, relative to the size of the sector as a percentage of the total economy, the contribution to growth is just off the charts. And so, what you're seeing is this sector is basically expanding at an extremely rapid rate and contributing to growth in a way that's like totally disproportionate to its size, which is consistent with like what you originally characterized it as, right? Like that you're hearing all these crazy capex growth numbers, and that's really what's flowing through to the aggregate GDP numbers.
Right, but on just looking at this chart here, and apologize for our audio only audience, but it doesn't appear like this is a ridiculous, never seen before number. Like in
Yeah.
the 1990s, it was over 1% of GDP yearly growth in real terms was coming from this, and now it's less than 50 basis points. So there's two ways to interpret this. Number one is that it's not that big of a deal, and the second one is that things could get a whole lot crazier.
Why not both, right? So I think the thing to recognize over there is that you had a totally different level of real GDP trend during those times versus these times, right? So like today we're looking at something that's basically like a 1 to 1.5, maybe 2% real GDP growth, depending on how you measure it. We think that we're at about a 1.5-ish trend. When you look at that type of growth and then you say, okay, we have 40 basis points coming from this one small sector, that's a pretty big deal. Now, if you wind back to the 90s where you have 4% real GDP growth, you can expect to have much larger numbers. I mean, I think there's also the fact that you have had a shift in the composition of those numbers as well. So there used to be a time where information processing equipment, so like computers and stuff like that, were a huge amount of the outlay. But as we've gotten more efficient over time at producing those, they become a much smaller part. But the part that's actually started to rise a lot is actually the investment in intellectual property. And so I think you've had a little bit of kind of like a reshuffling and also a downward shift in aggregate GDP growth, which explains what you're describing here.
How would you characterize consumption growth in America right now, and how how if at all has the trajectory changed because of tariffs?
I think we had some scares because of tariffs. So the scares were really. I won't say that consumption necessarily faltered because of tariffs, but what you did have is you had these massive swings in durable goods consumption and motor vehicle consumption when these tariffs were announced. And so you had, these eye-popping numbers around February and March where the numbers just went to the moon. And then when tariffs didn't actually come through in the way that they were expected, you basically had the numbers reversed really, really strongly as well. So, there's only so many washing machines and cars that households are going to consume. And so, people tried to beat the tariffs, front load their consumption, and that resulted in a big spike. And then the subsequent numbers were actually pretty weak. So we had I would say the March and April numbers somewhere around there. We had a little bit more weakness. You couple that with we had a pretty weak start to consumption in January. Now that might have been due to residual seasonality, or it just could have been just could have been a random month which was weak. But what that did in aggregate was it basically brought trend rates of and if you were measuring 6 month, 3 month, any of those types of measures, consumption started to look really bad. Um, and so, there were a lot more concerns about the economy and whatnot. But kind of looking through that tariff related volatility, what you see is basically a situation where, okay, we had a little bit of weakness in the trend, but the trend seems to have bounced back up. We're looking at about 1.8% annualized growth for consumption at the headline number. That is nowhere consistent with, any type of material slowing or recession. You look at the breadth of consumer spending. So, if you aggregate all of the sectors that go into the personal consumption expenditures basket, about 90% of those sectors are actually expanding, right? Which is, again, entirely inconsistent with any type of material slowing. So, consumption in aggregate, like all the sectors never contract at the same time. That never happens. Services spending is almost always positive, particularly with healthcare spending. But what you do have usually when you have a weak economy is you have at least, something like 60% of or maybe let's say 40% are contracting and 60% are expanding. Numbers around 90-95% of consumer spending expanding, it's pretty inconsistent with any type of slowing. And then last, I think the last lens that we like to look at is to look at what are the most cyclical parts. So durable goods spending and so furniture, washing machines, motor vehicles, basically things that are sensitive to the classical business cycle and interest rates. We look at those quite carefully, and what we see is that you did have this tariff induced volatility in those items, but when you smooth out the trends a little bit, even those areas are still expanding and contributing positively. So when you look across these various lenses, you look at the rate of change, you look at the diffusion, you look at the cyclical segments. I think it's very hard to make a case for a consumer induced weakness in the economy, or even a consumer induced window of vulnerability for the economy, which is really what's usually necessary for a business cycle contraction. So that's really why we've been saying that we basically like the environment really, really does look like it's a business cycle expansion.
You had a great argument. You've been on twice Monetary Monitors this year, and both times you shared your analysis about why tariffs actually wouldn't be that big of a deal in the economy. And so far, it seems like you're right. So congratulations on the good call, and I appreciate you making it on this program. Explain the logic once more to us. Just why was it? What was it? Because the imported goods as a percentage of GDP is just so small from a starting point, or is there another reason?
So we basically did a multi-step analysis to try and figure this out, right? And to boil it down, what we did after estimating a lot of sensitivities of so what we did was we treated tariffs as an inflation shock, and we said that, okay, how much would real demand respond to this inflation shock? And what we found is that it was fairly well distributed between imports and exports, so there wasn't actually like a big impact just from the trade balance to overall activity. The second leg that we looked at was to basically we wanted to understand what were the confidence effects of tariffs, which we thought to be the most important thing, right? Like if confidence effects were really, really large, then we would basically begin to have a business cycle downturn. And so when the tariffs were announced, the confidence effects were precipitous. They were very, very significant, as you could see from the from markets. But as we kind of moved forward, those confidence effects actually began to pull back. And so the main channel that we thought could really, really do damage to the economy was if businesses got really, really spooked and stopped doing fixed investment in the economy entirely, because they were like, hey, this is like too much of an uncertain environment. But within 2 or 3 months of the announcement of the initial tariffs, basically all of that reversed. And so we're basically now at a point where business fixed investment actually looks to be turning upwards rather than getting worse. And so that was the biggest threat. And with that behind us, we think that tariffs probably can't have a really, really big impact. And then the last, which was a pretty simple linear kind of analysis, was basically just to say, hey, okay, let's say we do 100% of these tariffs. Let's assume 100% of them are paid by corporations. What would be the effective impact on corporate profits? And we found that channel to be minuscule over time, like just not enough to be impactful. And so between those three things, the second avenue, which is the confidence effects, was the thing that we thought was the most concerning. But given how the data and how the economy has evolved since then, it doesn't look like tariffs are going to be that meaningful.
Well, so far, it looks like you were right, and I was wrong. So I appreciate your analysis there. What about the labor market this spring and summer? We've had a slew of quite abysmal labor markets readings. I'd say close to recessionary readings. Of the number comes out, and then in the subsequent reports, it gets sharply revised downwards. So in May, we learned there were only 19,000 jobs created. In June, only 14,000 jobs created. Those are levels that are, I believe, below replacement levels. So, the unemployment rate is just going to go up and up. I believe because people naturally just leave jobs and the like. What's your sense? What's your analysis of the labor market right now, and in particular, draw in immigration, which I know is something we've under discussed on this show, and you've done some work on.
Yeah, I'm really glad you actually asked this, because being quantitative and systematic, like we try to look at everything, right? So I don't want to seem like I have a one way bias that the economy is just moving forward. And I think that there are signs of concern in the labor market. Okay, but the labor market concerns are not typical business cycle concerns. Like, so how a business cycle usually works is you have changes in financial conditions, which is usually brought about by changes in interest rates. That ends up impacting companies' outlooks. They start investing less. That results in less total nominal spending. It compresses profits. And then those companies, in response to compressing profits, they start laying off people. Today, what we're having is we're not having that sequence of events. We're basically seeing a weakness in the labor market. And the question is, why are we seeing that weakness in the labor market? And what we think that weakness in the labor market is coming from is coming from slowing immigration. And so, many people are really, really focused on, say, like tariff policy, or the administration's other business related policies and whatnot. But where we think actually the policy impacts are potentially the most severe, and the most concerning, is the reversal of immigration flows. So when you look at employment growth, you can basically get employment growth from three places. This is not conceptual. This is mechanical and mathematical. Okay, you can either have it happen from population growth, just population flowing into employment, or you can have it.
AKA a 15-year-old turns into an 18-year-old and then they get a job.
Exactly, right. So you can have it come from population growth. You can have it happen from participation growth, right? Like, so some people don't work that for X, Y, and Z reason, but they decide to transfer into the labor force. You can have that as another driver. Then the last one is basically you can have more hiring for a given level of participation, right? Which is basically just a change in the unemployment rate, right? So what is a business cycle? A business cycle is when the unemployment rate is the driver of the changes in the labor market. So that's why, every business cycle contraction or recession is driven by spiking unemployment rates. It's not driven by big changes in the population or participation. Those are more secular phenomena. So when we can take those variables and we can reconcile them to aggregate employment growth. What we can also do with those variables is we can segment them into foreign and native populations. So we can see where participation is, whether it's coming from foreign or natives. We can see whether population growth is coming from foreign or natives, or we can see whether hiring is coming from foreign or natives. Now, one of the biggest drivers over time of total employment growth is basically changes in population. But over the last 5 years or so, a really, really important driver of overall employment growth has basically been inflows into the United States in the form of foreign workers. And that, with the administration's new policies, has begun to turn a little bit. And so the way we get around this is, so there are certain nuances in terms of how the data is reported. The jobs numbers are basically revised once a year. I'm talking about the household survey over here. So the household survey doesn't have any revisions all year, but then in January they have population benchmark revisions, which
And
basically
that's the QCEW from the census.
yes,
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 and that the house in the jobs report. There's two things: the household survey, the establishment survey. What I
yes,
read about 16,000, 14,000, that's from the establishment survey. You're talking about the household number. Yeah.
yes, yes, and those two over time they have to basically line up. They will. The good thing about the household survey is the lack of revisions, right? So the jobs numbers that you're talking about is that which is the NFP numbers are continuously revised all the time, which creates a bit of noise in terms of your point in time kind of estimation. But when it comes to the household numbers, you basically have this one-time big hit revision, right, which comes from the population benchmark adjustments. Now,
And
what's
in January, and so for a long time, like a long time, the people who have been saying that we're going to go head for a recession have been saying that the establishment survey numbers are too high, and therefore we are going to get downward revisions. Now
yes,
that actually has happened, but at the same time, the household survey had a huge upward revision in January, and I believe definitely over a million, maybe like 2 million, and I think that was because the census, the U.S. government realized, oh wow, we have way more people here in this country than we thought,
exactly.
and a huge driver of that I assume was illegal immigration.
A really really big part of it.
Yeah,
And so now the thing is, what these benchmark revisions do is they basically create these kind of sporadic rises in the data, right? And so what we can do is we can actually apply a little bit of like nerdy quant smoothing type stuff to figure out, okay, like what is the actual trend in the data, because population doesn't just explode in 1 month every year, right? So we can try to figure out what the trend is over time. And so when we adjust the official numbers for these population trends, what we find is that the employment numbers should be fairly lower, much closer to contraction. And so,
yeah. I mean, I'm looking at a chart from you that shows that literally it is in contraction
yeah.
with right. Yeah.
And so when you triangulate between the household and the establishment survey, kind of put those two together, basically what you're looking at is a labor market which is basically neutral or possibly contracting. Now, I think the really, really important thing is that contraction, it's not a business is bad, the economy is going through a really, really bad time, like we're going into contraction. This very much looks like a policy induced immigration is reversing, reducing one of the largest flows into the labor market kind of contraction. And so yeah, like I think that the labor market is weak, but it is not necessarily a business cycle weakness. This is a policy induced weakness.
And so that weakness is fundamentally coming from supply rather than demand, which means it's really not a a weakness or a recession in the way we typically think of it. It's kind of like in the way Japan's labor market is weak. It's just because there's very anemic growth in working age population.
Absolutely, and that's it, right? Like it's a we're at a really weird instance in time, because at least in the U.S. experience, we haven't had much of this, if any of it at all, over the last 60 to 80 years. And so I think we're in a very interesting and kind of weird spot where the labor market is one of the most important things. It is the central force in the economy, right? So, the question is, what is the outlook for the labor market? And I think that a really important part is that, okay, we could have anemic labor market growth, but that doesn't mean a precipitous contraction in labor markets that sustains itself to the downside. And so, yeah, we're definitely in a unique spot, which is, which we haven't experienced really in history before.
So a very large percentage of the population growth from 2023 to now has been in foreign born, not in native. Likewise, a decent sized percentage of the growth from the employment rate
Mhm.
was in foreign born workers, but now they're both contracting. How would you characterize this, and what is going to happen from basically foreign population going down, or the growth rate of foreign population going way down? How is that going to impact the overall unemployment rate, and just absolute numbers?
So the impact to unemployment rates is not going to be a big deal. Like that is not going to be a super big deal, because the unemployment rate is the tightening or loosening, which is the demand forces that you described. That's not the big part that matters. The big part that matters is going to be basically the population flow, which sets the baseline trend for labor markets. And so what you're not going to, so, looking forward, let's say that we have, employment growing around 1% ish. You can expect it to grow, to continue to trend lower, but you don't have to expect it to fall off a cliff. That's basically the takeaway. The takeaway is that we're probably in a lower labor trend rate of growth relative to, a labor, a labor shock where labor just falls off a cliff, which is what we've typically seen during a lot of these slowdowns. So I think that we're basically just going to see a grind lower when you look at these forces.
And do you think that GDP growth will go down or moderate because of uh, reversal of immigration? And GDP really, if you're a GDP maximalist, you want as much immigration as possible.
Mm-hmm.
So it really is not a political point, but it's possible that reduced immigration flow would be good, but that it would lead to reduced GDP growth. But how is that going to impact GDP growth?
Yeah, I think it's definitely a weight on GDP growth. Like, I think it's way harder. At the end of the day, the fulcrum of the economy is the consumer and how many people are consuming and spending in the economy. So if you're shifting down, you're downshifting labor market growth in total, you're going to have a downshift in GDP growth in total. But at the same time, that it doesn't necessarily mean that business activity and business investment also needs to contract, right? Like we talked about this weird kind of dynamic where particularly tech firms are investing just huge amounts of capital despite actually shrinking their labor forces. And so, yeah, I mean, I think that we have two pretty competing kind of forces right now, which is that, okay, the labor market might be trending lower, which basically means that you're going to have a little bit of a drag on consumer spending. But at the same time, like the amount of wages that are being paid by companies and the amount of investment that's being done by these companies is still pretty robust. So I think when I look at it, I think labor probably gonna slow a little bit, which is gonna weigh on GDP. At the same time, business conditions are pretty good. So I would say slower GDP, but not like terrible GDP. That's the synthesis.
Thank you, Ahan. So, but what about the very weak non-farm payrolls, like the May and June number, 19,000 and then 14,000 jobs? Surely, even though the supply is going down of labor, surely that is below the replacement rate. And talk about what is the break-even level? Like before, there used to be a certain number of jobs that you had to add every month for the unemployment rate to stay stable. Maybe that level is lower now, but it's probably above 19 or 14,000. Like if we keep on printing 19 and 14,000, the unemployment rate will go up, right?
Yeah, and that is true if we keep printing those types of levels, right? But so I think the way I would think about it is less. The question is whether we're going to keep printing those numbers or not, right? And I think that for you to continue to keep printing really, really weak jobs numbers, what you need to have is you need to have a little bit of the demand side fall off and fall off pretty strongly. And when you look up the cause and effect chain, where does that demand side weakening come from? It comes from really weak business activity, and we're not seeing that. And so, barring a really, really material kind of deterioration in profits and in corporate activity, I don't think that we're going to actually see the sustained weak prints like that. If you average the household survey and the establishment survey, you basically get to about neutral labor market growth. And I think that like almost all of that is driven by this population dynamic. It's not driven by a tightening of business conditions. I think that's the main takeaway. And so um, I definitely don't think the labor market is gangbusters. I think that we're getting a really, really different picture from spending and labor. Like we're getting two totally different pictures. What you want to do is you want to split the difference and say, okay, like we're not, we're basically the labor market is telling you the conditions are basically neutral across a variety of measures, but spending is telling you the conditions are pretty good. What you probably should think is that okay, reality is somewhere in between those things where we're in a positive-ish situation, um, where we don't have a recessionary circumstance, but we're also not in an all-time boom or anything like that.
Now let's talk about manufacturing. Manufacturing about 15 to 20% of the economy. Even though the economy was still strong in 2022, 2023, 2024, manufacturing actually, you could say was in a slowdown and maybe even a recession. Uh, are you seeing some green shoots there for manufacturing?
Yeah, 100%. And this is one of the another reason why we think that the business cycle is still expanding, albeit at like a more modest kind of clip. um, Manufacturing basically has been like going through while the rest of the economy is doing what it's doing, like manufacturing is basically going through a recession for the last 2 or 3 years. And a big part of that was basically just pretty depressed top line and really elevated wages, and also the fact that manufacturing firms are basically very, very indebted. You combine those three variables, right? Like it's a very tough environment for manufacturing. But what we basically started to see is actually that manufacturing sales. So if we aggregate manufacturing and trade sales, what we started to see is that activity has actually started to pick up over that. While at the same time, the manufacturing firms have also laid off their employees. So I think the last time we spoke, what we basically started to see is a little bit of right sizing. During our last conversation, we had started to see a little bit of right sizing, and what we're seeing now is that a lot of that right sizing is actually starting to flow through, where manufacturing firms have managed to lay off a bunch of workers. Sales have remained largely stable in terms of their growth rates, and interest burdens are roughly around where they were previously. The combination of those things is basically creating a neutral environment for profit growth, but that is a way, way better circumstance than where we were a year ago or even 6 months ago. And so if we continue on this current trajectory, we could very well be in a manufacturing expansion. We're starting to see some timely indications, in terms of manufacturing orders, in terms of some PMI surveys and things like that, tell us that manufacturing activity and manufacturing top line might actually be a little bit better, even, which would basically bring manufacturing profits out of a contractionary zone. And so when you get to a point where manufacturing profits are actually positive, you basically get into a situation where one of the biggest laggards in the business complex is actually now turning into a positive, and that is an overall support for the economy as well.
Hope you're enjoying today's episode. Semiconductors have driven decades of innovation, resulting in massive efficiency gains in the global economy and powering tech giants such as Google and Amazon. SMH by VanEck is a focused ETF that captures the whole semiconductor value chain, from top tier designers like NVIDIA and Broadcom to foundries such as TSMC through the equipment makers and software developers. Its market cap weighted, concentrated approach has helped SMH outperform historically its closest peer. Go to vaneck.com/smhjack to learn more. Building on the design and success of SMH, VanEck saw an opportunity, and it launched a fabless semiconductor ETF, ticker SMHX. It gives investors targeted access to the high-margin, capital-light segment of the semiconductor market. The fund focuses on chip designers that outsource manufacturing and are driving AI optimizations and applications at the edge. Go to vaneck.com/smhxjack to learn more. And now back to the interview. So, Aahan, how has everything we've talked about shape your asset allocation view on stocks, bonds, and commodities? But let's stick with stocks and bonds right now.
We can start with stocks. So I think it should be clear there. Like I think that the economy's fine, that we're in an expansion. I don't think we're in like a rapidly accelerating expansion of any kind because of the labor market challenges that we have. What does that really tell me about equities? It really tells me two things. It tells me, one, don't be short equities. Like that'd be the first thing, right? But at the same time, it also tells me not to be max long equities, right? So like we think that a modest amount of conviction in an expansion, like one of the worst things that you can do is during an expansion, try to put on a really aggressive short position based on some type of pricing. Now, what we do think in equities is that equities, relative to their own history, relative to conditions, relative to the rest of the world, are really expensive, right? And that is a weight, and that potentiates loss in the future, right? Like that, it's kind of like really like overvalued equities basically just need a catalyst to sell off really significantly. Now there's a whole Pandora's box about whether equities are overvalued or they're expensive for a reason and all of that. I don't want to necessarily get into that too much, but I think the big takeaway when it comes to equities for us is that, hey, like they're really expensive. They're really expensive relative to the rest of the world. But at the same time, there's no reason to necessarily be short them so long as you expect the business cycle to continue expanding. So the way we're approaching it is like be long, but don't have too much of them and don't get too attached. Uh, when it comes to fixed income, I think particularly U.S. fixed income, U.S. Treasuries, the challenges are a lot more significant. We I have I have something I tweet every other day, which is that bonds are the worst. Uh, the reason I say that is because the pricing on bonds has basically been, over the last few years, has basically just been consistent with markets always expecting cuts and always expecting a lot of cuts at the very hint of slightly weak data. I think when we look at what's happening today, we don't think that the economy is in a really bad shape. And today, bond markets, in the futures markets, are pricing at about 4 or 5 cuts over the next 18 months. And so, when we look at that, we say where those types of cuts only come in a slowdown type of environment, like in a big slowing kind of environment. And we just don't think that we're in that regime. That's one part. The second part is, when we look at the shape of the bond curve, right? Like we aren't, maybe in tenure, but we're generally just not being compensated a lot for the risk of a potentially resilient economy. And so holding bonds in a portfolio right now, barring a really, really bad growth event, is just not, it's a drag on your portfolio. So when we look at bonds relative to, say, like equities or, global bonds or anything like that, they just look very, very unattractive to us right now. And so our strategies, which do have a lot of timing involved in them, so, it's not like our strategies are short, right? Our short nominals right now have been short nominals for the last week or so. But I think the big takeaway that I have for someone that's listening to this is that, it's very hard to get a bond rally here without having some type of recessionary circumstance. And we just don't see that as likely.
I want to say that you work for investors who try and have a high Sharpe ratio. They try and optimize their return relative to their risk, and by definition, that focuses on short term stuff. So if people are longer term investors, which I encourage them to be, like it probably won't matter. And likewise, if someone watching this who works at an insurance company, like you could be totally right that bonds are a bad trading vehicle, but like they should be buying it as they're an insurance company. They buy bonds, so it's everything you're saying could be 100% correct, but wrong for the right person. Because it's ultimately investing is about you and your needs. But with that being said, so you prefer equities over bonds.
Mhm.
I mean, don't you think that the cuts priced into the curve? I understand you're saying they're excessive, 4 to 5, but like the inflation is so far below where the Fed funds rate is. Like I feel like the Fed is I feel like the Fed is going to cut a lot. You're just saying that it's unlikely that they're going to cut by way more than it's priced in, so you're not getting that extra reward.
Yeah, and look, that's the thing, right? Like for you to make money or have like any type of like alpha, you have to get more than what's priced.
Yeah.
If we do exactly what's priced, nothing's going to happen. And so that bet won't pay off at all. And so yeah, I just think that the there will come a time to buy a lot of bonds, and that'll be when the labor market and growth data all support like a really really weak economy. But I just don't think that what we're seeing from all of the data that we look at right now is indicative of a very weak economy, which is going to support that bond bid.
And Aahan, I mean, I'm looking at your charts now of the future expected path of rates, basically what's priced in by the market. And yeah, over 5 cuts priced from now into February 2027.
Yeah.
And the curve from now until way out, it always looks the same. It's looked this way, say, since like the late 2022 of the market's pricing in all of these cuts, and then it prices out cuts for a year, and then a year out, maybe the Fed will hike again and stuff. But like this has been the curve, for like 3 years now. I understand that, with the 2s, 10s, there's been a lot of steepening, and particularly in the ultra long end, like the 30-year, there's been some steepening as well. But like the short-term interest rate futures market has broadly had this shape for 3 years.
Yeah, and that's exactly the challenge that's in bond markets today, right? Like that's the thing that has made bonds hard to hold. Like if you had a situation where the Fed funds futures markets were just flat, like they didn't expect anything, I would be happy to own some bonds. But the thing is, the pricing has become over the lot, and there might be some sort of institutional bias or some sort of structure that does this, but it's just that the pricing has become so biased towards expecting cuts over the last few years, that it's really hard to find any value in owning bonds. This is very much a value conversation, right? Like there's value in owning bonds when there are hikes expected, not when there are a tremendous amount of cuts expected. And so that just basically that, and the fact that we basically have nominal GDP which has stayed resilient over the last few years, it just makes bonds like a complete no-no. Because when you basically look at bonds, right, like what are you trying to do? You're trying to get the most yield possible for the least growth. It sounds a bit non-intuitive, but basically all you're trying to do is you're trying to say, hey, like I want a lot of yield for almost no nominal growth. That is the best setup. That setup can be applied globally. You can apply that. We systematize that framework in a more complicated fashion, and we apply that to global fixed income. And when you look at the world through those lenses, what you'll see is that US bonds are like the least attractive fixed income asset globally. Like, your European bonds are far more attractive. Like even, I think the only fixed income assets that like look better, look possibly as bad is like UK fixed income. And so, that framework is basically globally applicable, and it's a universal one. And so when you're looking at the situation today, you're not getting much yield, and you're getting a pretty good amount of nominal growth, which is basically, bonds are the worst.
So explain what you mean by the highest yield and the per unit of growth. Is what you mean? What you want is like an 8% yield, and there's not that much growth.
Yeah,
that's what you want. But the US, the growth is high and the yield is not that high.
A really good situation would be an 8% yield with a negative 5% real GDP growth. Because what you get is you get the carry, right, which is the 8% yield, but then you also get the very, very high likelihood that you get a bunch of interest rate cuts, right? And so what you have to recognize is that the stuff that's priced into the futures curve, right, the Fed funds futures curve, is also reflected through the entire yield curve, right? So what you really want is you want an upward sloping yield curve with pretty bad growth data or expected to be bad growth data. That's the best setup to own bonds ever. Like, 2-3 short.
But it rarely happens because in that scenario, everyone prices in the cuts already, right? I mean, maybe it happened in the 80s, but it doesn't happen that much now.
I think it happened a lot until the 2020s.
Yeah, I mean, I think the impulse now has been just to always price in the Fed's going to cut. Oh my God, the consumer spending is only 6%. The Fed's got to cut.
Yeah.
The impulse in the fixed income market has been the other way.
Exactly, and that's basically, and that's the thing. That's not been true in other countries. It's been like a pretty uniquely American phenomenon, right?
Hmm.
And so what that actually allows you to do is that allows you to trade those bonds in long short pairs, and that's basically what we do in our institutional programs.
Um, so I've seen you say this before. You prefer global bonds to U.S. bonds. Isn't everything priced through the currency? Like if you say you prefer European bonds over American bonds, aren't you really saying that you prefer the euro over the dollar? Because like the currency and fixed income really is the same thing. And you can generate, you could generate a Swedish fixed income bond by just buying a 10-year treasury bond and then doing a US to krona swap, right?
So what we do is we operate in FX headspace, right? So what you want to do is you want to neutralize for your FX first. The FX can be either it can be a plus or a minus. But what you want to do is you want to neutralize the FX components, and how you neutralize the FX components is basically by looking at the short rate differential. So basically, like what is the 3 month in this country versus the 3 month in that country, and you neutralize the short rate effects. Then what you do is you look at the yield curves for the individual countries, and then you compare them cross-sectionally. That's basically what we're talking about. And so when you look at the yield curves, right? So like the item you're describing is the interest rate differentials, right? Like the short rate interest rate differentials. That is one part of the total yield, but that is entirely just an FX bet, like you're describing.
Mhm.
What I'm talking about is the shape of the curve independent of those interest rate differentials. So if you look at yield curves globally, right? So if you look at like say UK, Europe, Italy, Italy, France, Germany, all of these yield curves, they offer way more value than US yield curves. And then when you adjust for the fact that their growth conditions are probably actually worse than the US growth conditions and likely to remain worse, you actually get way more value in owning those yield curves than you do the US.
Explain that. Explain that.
Okay, so basically, when you have an interest rate differential, right? You the bets you're making are not like when you FX hedge, making sure to basically neutralize your FX entirely, right? Like you don't want to have any impact from like the FX changes. So that part is canceled out. Now there is a small residual part, which is basically the difference between the interest rates, right? That component is a carry. So like this might be a little complicated.
Well, it's hedging, right? Like if like I interviewed a guy from Oaktree, he said he kind of likes European bonds right now because he could buy the European bond and then hedging it back into dollars
Yeah,
is a positive carry thing because
it's a
dollars
positive carry
yield
thing,
more than
right? And so those are two separate trades, though. It's really important to recognize that the FX hedge part, it can be really attractive, right? So that carry in itself can be attractive. But what you have to recognize is that's one leg. The other leg is the difference between the local FX bonds, right? So what are the local FX bonds? The local FX bonds are basically changes in the shape of the local yield curve, right? And so when you look across those bonds globally, what you basically see is that the local FX bonds in other countries are way more attractive. The FX component is a completely different like conversation. But what you can boil down that conversation to is whether it's positive carry or not,
Mhm.
right? So if you can get positive carry and you can also get a really nice yield curve relative to US yield curves, you want to own those bonds. And that's basically what you have in a bunch of European countries relative to the US.
And large institutional managers, some hedge funds, but also just huge pots of money that have very long term, or at least claim to have very long term goals. I'm sure they are taking your analysis, whether they hear from you or other people, into account. But do you think that for a lot of certainly individual investors, but also even like the sub-billion-dollar hedge funds, like no one's really getting involved with Italian, government bonds unless that's their mandate and they're doing relative value type stuff. But it's just the U.S. Treasury market is the only game in town, and because it's the only game in town, it kind of remains the only game in town.
I think so, and that might be one of the reasons why you have like these ridiculously rich yield curves here, right? Like, so if you think about it, if okay, if I'm running a lot of money, or I just don't have access to like BTPs, right? If I want to express a risk on
So
bet,
Italian government bonds, yeah. I
yeah,
don't know what
yeah,
it stands for, but yeah, Italian government bonds, yeah.
right. So I'm not gonna go and express it, in Italian bonds. I'm gonna go express it in the United States bonds, and there's an extremely liquid market and all of those types of things. And that might be one of the reasons why you have basically these yield curves that are extremely rich over here, right? Like you just basically get no carry because there's a crowding kind of effect. And so I think that might be like one of the causes. But I mean this less as like, hey, go buy Italian bonds or German bonds or something like that. I mean it much less as that type of recommendation, rather than it's just an indication of how rich U.S. bonds are relative to the rest of the world and relative to conditions. Like it's more, yeah.
And so swapping out all the FX, just totally FX hedge, just give me a sense in terms of basis points, like the US 10-year versus the German or the Italian 10-year. How much are we talking in terms of the richness?
Like 100 basis points.
Really? Wow.
Yeah, like 100 basis points. Like if you're just looking at like yield curve versus the yield curve, somewhere in the 50 to 100 basis point range. So yeah, quite
And
sizable.
so US Treasury bonds, US government bonds are extremely rich, overvalued compared to their European counterparts or counterparts around the world. Is that differential, that overvaluation differential, is that greater or less in the bond market than the equity market? Because the US stock market is also way richer than the rest of the world, right?
Yeah, I think with the US stock market, it's definitely richer than the rest of the world too. But the thing is that there's a big difference, right? Like, so bond markets are fixed income, right? Equity markets are contingent upon growth, right? So like when you look at equity markets, US equity markets, they're definitely rich versus the rest of the world. But the thing is that they're rich because they have the earnings growth. Like they have the earnings growth power. And so you have to combine those two lenses when you're evaluating the attractiveness of those assets. And US equity markets are like, by our measures, like the fastest growing earnings growth across the world. And so when you take that into account, you combine it with the valuation, we think that US equity markets are still attractive. Are they the only thing that you should own? Absolutely not. But I think that you get this kind of divergence in terms of picture because you do actually have the earnings growth to support the richness and valuations in the United States, which is why you can't go out and just do the value thing, right? Where you just say, hey, like U.S. equity markets are so expensive, all these other countries are super cheap, but maybe they're expensive for a reason.
Yeah, like if South African equity earnings were growing at 20% per year and then the US was growing at 20% per year and you had the valuation differential, of course you should buy South African equities, but I don't believe that that is the case. Um, just how much have the corporate earnings been growing? I know that going in, expectations were very, very high. And then I also know that actually with the second quarter earnings, they just blew it out of the water even more than the analysts were kind of made happen because they always sandbag the numbers. Um, so just tell us about the scale of S&P earnings growth as well as how does it compare to history?
Yeah, so what we monitor, we don't monitor the realized earnings growth. Like that's not something we pay very close attention to. What we look at and try to focus on is the changes in earnings expectations, right? And those two things are fairly correlated to one another. But basically, like what you'll find is that the changes in earnings expectations actually lead the actual earnings expectations, one, and two, like they're much more relevant for asset prices. So
The change in earnings expectations leads, i.e., comes before the actual earnings.
yes,
Yeah,
yes.
and is
You've got
predicted.
analyst guide, people are tracking data. So what you typically see is that the changes in earnings expectations actually pass through to realized earnings expectations pretty well. And it's also very relevant for asset pricing. Those earnings expectations are basically up about 8% year over year. I believe the realized numbers are somewhere in the 10% range, and the expectations were like 5 or something like that. So yeah, definitely blown out of the water. So we have models for earnings expectations for both the Russell and for the S&P 500. We actually think that those earnings growth numbers actually get a little bit better. Um, So, but the room for that is very, very small. Like I'm talking about, like we expect it to go to 10%. It's currently at 8%. It's not a very, very big deal, but nonetheless, it's just a sign of current positive conditions. And so, yeah, like I think that, a big part of being able to beat those expectations was people really worked up about tariffs for a little bit. Earnings expectations came down a lot, and then as people have become less worried about tariffs, those earnings expectations have started to rise, and so that's really what we're seeing in those numbers.
And how do you attribute the changes in earnings and earnings expectations with the macro? Because I attribute the high level of earnings growth in the S&P 500 to, let's say, two things. One would be keeping, not hiring people, or in some cases laying people off while the top line continues to go up, so earnings go up. And then also, I think that's, I mean, for really one company, Nvidia, just the growth there, AI capital expenditure has just been enormous. And also some of the companies who spend on AI capex, they do a depreciation schedule
Mm-hmm.
where they only take basically 10% of a charge of the investment. So some critics like Jim Chanos, for example, have made the argument that this leads to inflated earnings expectations in the short term. But everything I've said, whether it's right or wrong, is micro. How does that overlap at all with your world of macro? Like, how could you have predicted the high levels of earnings growth we've seen this past quarter and past year and 2 years, frankly, by looking at the macro? Because I mean, on the macro front, everything has kind of been slowing down. Not a slowdown, not a contraction in real terms, but just real growth has been going lower and lower and lower, right?
Yeah. So I think it boils down to uh, profits. Like so earnings are basically profits, right? Like so, and people that do NEPA accounting, which is basically just the GDP accounts, look at it. We call it profits more often than we call it earnings. But those two things are basically synonymous, right? So if NEPA profits are doing something, it's usually consistent with what S&P 500 earnings are doing. Largely, you have to make some sectoral adjustments and whatnot, but those two things kind of move in sync. It's the macro of it all. Now, the thing is, like, where do those profits come from, right? Profits are not the same as GDP. Like, GDP is somewhat ish synonymous with top line, but it's not the exact same as bottom line. And so, what a lot of people do is they basically say, hey, like, I'm going to take my GDP view and then that's my profit view. That is not always the best way to do it. What we think is, like, you can actually identify the drivers of profits. So I think your listeners may or may not be familiar. There's a very popular equation called the Kalecki-Levy equation, where you basically look at what are the sources of profits. So what are the sources of profits? There are four big sources, right? It can come from consumer. It can come from consumers. It can come from households. Consumers and households. It can come from the government, or it can come from businesses' own investment, like as you were describing, right? And what we found is the most consistent explanatory variable for profits over time is businesses' own investment. Like, for intuitive reasons, that makes sense, right? Like, businesses invest, they generate more, they generate more output that turns into profits. It's also it also creates kind of leverage for the companies. And so what we try to do is we try to focus on two things really, like, a lot more than everything else, which is one, like, how much are consumers spending and how much is that flowing through to profits, and then two, how much are businesses investing net of capital consumption adjustments, which is the NEPA convention for the depreciation you're talking about. And so when we look at that, what we basically say is, like, can we get a really timely read of whether businesses are investing or not? And when we looked at that, we had this AI, like, we essentially captured this AI capex item that we've been describing, right? You saw those investment drivers that we showed in the slides. What we basically saw is that, okay, you do have some downdrafts, but this kind of AI capex kind of item, which is the information and equipment investment, is basically super strong to the extent that it's not going to allow the rest of the economy to contract. You take that, you add up that, okay, consumers are still spending. Put those together, you get an aggregate, which is which was basically telling us, okay, consumer earnings expectations are probably likely to still go ahead. And then when you took into account the really bad conditions that were created by tariff induced earnings expectations crash, right? You basically had a gap between the likely path and what was priced in. And so that's basically, how you go about creating, like, how you would think about, the difference between whether earnings expectations are going to be good or bad, that type of thing.
So the high level of valuation in the S&P 500, is it a source of concern to you, given that uh, is the, is that a concern to you? And also, what's the relationship between long-term return expectations and valuation? Like when stocks were ridiculously cheap in the 1970s, when Buffett and Munger were buying them hand over fist, the long-term realized returns from 1974 to now are ridiculously high. Likewise, buying in 1999 when valuations were very high was long term, extremely long term, we're fine, but for the 10-year returns, we're not good at all.
Mhm.
So I assume there's some somewhat correlation on a decent sized time horizon between valuation and equity returns. Just how big is that, and how concerning is that for long term investors? Because you're more, a lot of your work is relevant more in the short to mid term, and so that may not be the game you're playing. Nevertheless, for a long term investor watching this, it's definitely relevant.
Look, when it comes to looking at earnings yield or valuation as a long-term predictor of equity returns, I think the first thing to recognize is that it is very much a belief-based thing. Okay, like if you like the intuition, you like the logic, and it seems consistent to you, you need to recognize there's not enough data to validate that view. Right? It is very much like I like this way of thinking, and it makes sense mechanically. I happen to think so. Right? Like I happen
Yeah.
to think that earnings expectations, and earnings yields are generally good ways to think about equity markets. But let's start by saying, like, from a quantitative perspective, it's just not enough data to validate it.
What do you mean? I mean, there's however 250 trading days a year.
Mhm.
Every single day that happens has a trailing and maybe forward, but, based on the future expectations. Who knows? But every day has a PE ratio, and then you can look at the 10-year returns after from that day. That's 250 times over 100 pieces of data.
So this is some quant node stuff for you, but that is not 260 times n number of years, because what you have overlapping observation.
Oh yes.
So it's actually more like 60 data points, maybe. And 60 is not enough to make any type of inference. And when you actually reduce the sample to the 50 to 60 data points, you'll find that that relationship is not actually very good. So, from a quantitative standpoint, it's not a very, rigorous thing to look at. But like I said, I think that if you think the mechanics make sense, right? Like that, okay, like, companies generate X amount of earnings per unit of share price. And that earnings should be indicative of how much return I earn over the next, over the long term. That's a totally acceptable way to think, right? Like I think it's just really important to know that it's not quantitatively verified and not true. It's a bias and a preference. I happen to like that. I happen to like and have that bias and preference, but the caveat is important. But
Yeah, I
so
mean, if you don't have, obviously, companies that grow higher and have sustainable moats, so they have a higher percentage of staying dominant,
mhm,
should have a higher multiple.
mhm.
But so a high multiple for Nvidia to me makes sense. A high multiple for Costco to me does not make, like, a 60 multiple on Costco does not make sense. There are very high quality companies that are not growing at 50% a year that have a PE of 100. To me, of course, that doesn't make sense. I feel like if you don't if you don't value that, like, what is even your basis to be an investor? Because, like, you talked about carry. Okay, I don't like the 10-year because it yields 4.5, and the cash rate is slightly lower than that. So the carry is nothing. Like, I feel like you also compare the earnings yield of companies to the cash rate as well. It's carry as well, right?
Yeah, and I mean that is how I think about it. But like I just want to recognize that it's not a rule of law, right? Like, the carry on a bond is quite literally carry that you own. The carry on an equity is an implied promise, but nonetheless, like I don't want to get too academic about all
Yeah.
this. Like when I think an important aspect of looking at equities generally is to recognize that yes, the carry is important, but the earnings growth is also important. And so, going back to the original question about looking at equities and the fact that they're expensive, I think that you have to weight both sides of the coin equally. That, okay, like US equities are really, really expensive, but they have been expensive for a while. And importantly, they are actually putting up the earnings relative to the rest of the world. And so, should I just look at valuation only and say that, hey, like zero allocation to US equities,
Yeah.
100% allocation to EM equities? I don't think that's a reasonable choice to make. I think what makes sense is to, understand that US equities are performing really well because they put up the earnings, but also recognize that they're really expensive and not offering me that carry that you described. And so, I would want a middle ground allocation between the US and the rest of the world where I'm getting better valuations but less earnings, and in the US where I'm getting really bad valuations but really good earnings.
What about commodities?
On commodities, we have there are two different sets of views that we have. So the first has to do with industrial commodities, so nickel, copper, etc., and the second has to do with gold. So when it comes to the industrial commodities, our views to the industrial commodities are basically linked to that entire manufacturing discussion that we had earlier, right? Where we basically see a nascent kind of recovery in the industrial and manufacturing sector in the United States, which is very, very highly correlated to the rest of the world manufacturing sectors as well. And so what we're starting to see is a bit of an uptick and an improvement, and that improvement from a negative kind of zone is usually very, very positive for industrial commodities. I believe we have it somewhere in the slide deck, the relationship between the two. And so, generally on industrial commodities, a little bit more bullish. We were negative a little bit earlier, but, over the last month or so, we've started getting more bullish. Um, so that's the industrial commodity side. And then on gold, gold is unique relative to other commodities because it's basically an FX, like a FX alternative. Now there are many drivers, like I would say that there are basically like three big ones, three big drivers of gold. You basically have the jewelry demand, which is honestly the biggest driver of spot demand over time. The second driver you have is kind of like the central bank buying, and then the third driver you have is the demand for gold as an investment, right, as an investment asset by the private sector. And so, all of these drivers matter.
Right, because
Interesting.
in jewelry, I'm sure you're right that in gross terms, jewelry is the number one, but there's a ton of recycling. So
Yes. Yes.
in net terms, jewelry is less, I think, than
Yeah.
central banks.
And there's also the fact that there's the elasticity, right, and the speed of the demand which comes through, like so like a lot of, like, for example, ETF flow, right? Every time there's AUM flow into all of these ETFs, there's immediate demand that actually is met for gold on a daily basis. So if you have vast AUM flow, which can just be a rebalancing flow, it actually just creates physical demand for bullion. But nonetheless, like what we've basically seen is that the combination of these, central bank reserve demand and ETF and basically ETF flows have basically driven most of the price action in gold. Interestingly, we've actually seen a slowdown in the central bank demand a little bit over the last few months or so. The data is a little bit slow, so it's tough to get a very timely read. But what we do see very, very consistently is that the ETF flow is extremely strong, and that continued ETF flow is largely just consistent, I think, in large part due to the underperformance of fixed income as a diversifier relative to equities. And so long as we continue to see this flow, which we have developed some tools to sort of work on forecasting, as long as we can continue to see this flow, we think that gold prices are probably going to be supported, and they're also likely to offer very nice diversification characteristics relative to more traditional fixed income. And so, yeah, we're both, for the time being right now, based on industrial demand conditions, uh, we're bullish on the industrial commodities, and then we're also bullish on gold because of these various other properties.
So Aahan, you cover stocks, you cover bonds, you cover commodities, but it's my understanding at Prometheus, you've recently expanded your coverage universe for what your model portfolios track. So tell us what's new in the sauce.
We're basically it's an exciting time because we've basically spent the last year or so taking the tools that we've applied more traditionally to just S&P 500, U.S. Treasuries, and taking that framework and those tools and applying them to a more global set. of assets. So we've started covering over the last year. We've started covering U.S. equity sectors. We've started covering global equity markets. We also, as listeners may have guessed, we've been covering global bond markets in relative value format. We have a variety of commodity strategies, and we also have some nascent volatility strategies as well. So yeah, a lot going on. We've really expanded the offering and the diversification characteristics of that offering. So I'm very excited and proud.
And I'm curious about the sectors, because a lot of the US equity market sector classification I would call as somewhat fake. And I think like if you talk to the S&P people, they would even acknowledge that in a more polite form, what I'm saying is true, that like so much of the stock companies are actually technology companies. It's just like, okay, we have to put Tesla in consumer discretionary. We have to put Amazon in consumer discretionary. We have to put Google in communication services or Alphabet, because if we put everything in tech basket, the tech basket would be like 70%. So
Yeah.
I don't think there's actually that much signal relative to noise in the categories themselves, at least when it comes to the big cap techs. And yet you are finding a lot of signal in terms of the diversification benefit. So that's interesting. So tell us about the strategy, and what have been some overweights and underweights, and any other observations that you think I and my audience would find interesting.
Yeah, I think the more exciting place has generally been global equities, but just to speak to the sector thing, um, I think you're totally right that like there is a huge amount of co-movement in the sectors, right? Like and like communication communication services is basically tech. Like the tech is tech.
Tech with a
Um,
bunch of really old like
yeah,
telephone companies. Yeah.
exactly. And the telephone companies have basically turned into tech companies too. So it's like, but in any case, I think nonetheless, what you do have is they are still independent securities, right? So that's one, right? Like the PE ratio of, let's say, the tech sector is going to be different from the communication sector. The earnings growth is going to be different. The earnings revision breadth is going to be different. Importantly, the price characteristics can be really different, right? Like that one can be trending, one cannot be trending, and all of those things in quant world are valuable and add diversification. So that's one thing. The second thing is I think that you're totally right when it comes to like the more modernized sectors. But then when you look at something like utilities, or you look at something like energy, the industrial sector, home builders. So we prefer actually relative to the real estate, the S&P 500 real estate sector. We typically prefer trading home builders, and so those sectors are actually pretty meaningfully different. So yeah, is there much difference between trading communications and tech? Not really. We've actually found that our signals actually like tend to fire at the same times for those sectors. But what you do find is that if you're trading, say, like a relative value trade between home builders and energy, or energy and tech, you actually get some pretty meaningful diversification benefits. So I think that's one thing. Second thing, in terms of like what's been interesting, what we found has been really like exciting in terms of our strategies. Like, so we in our multi-strategy program, we cover about 39 different assets which span 9 different strategies. And the sleeve that has been just absolutely gangbusters this year has been the global equities theme. And I think the most interesting part about that is that you would think that the primary exposure in that global equities basket would be to be long U.S. equities, but we actually, like, for most of the early part of the year, that program, because of the relative valuation dynamic that we described, had a very minimal short. Actually, had really aggressive exposure to China, and now as we kind of go further into the year, we're actually starting to see the U.S. sleeve tick up more now, which is I think it's just indicative of the fact that, okay, we've been talking about a lot, the valuations might be really high in the United States, but at the same time, like, there is no denying how strong the earnings are. And so when we're basically looking at the world today, it is definitely true that the United States has, both in terms of stocks and bonds, really expensive assets. But I think the thing that's driving the U.S. stocks to be expensive is basically like a concentration of really high quality companies that seem to generate really good earnings. And so that's basically what we're seeing from the global and sector kind of views.
I was very intrigued because I'm in my personal investing and extremely discretionary. You obviously are extremely systematic, but I also happen to be quite long Chinese equities. When you are um, looking at your models are looking at where to allocate in the equity world. You said you were at sometimes modestly short U.S. equities, but long China and long the rest of the world. How has the performance of other markets been relative to the US dollar? Because in dollar terms, the S&P 500 is gangbusters, but in FX hedge term, it still is good, but it has underperformed other markets, some other markets, right?
Yeah, I mean, I mean, like at the start of the year, China was definitely exactly like that, right? Like that was the theme, the thing to be on. But when it comes to equities, the thing is that FX vol. So there are basically two different like parts of the world, right? So you have fixed income and you have equities. Most fixed income investors, because FX vol is so high relative to fixed income, like so a treasury or any fixed income asset runs at like a 4 to 8% volatility. So you have to FX hedge over that, right? But when it comes to equities, when particularly like years like this year, you don't actually have to FX hedge your
Because the stocks move more than the currency, whereas for
exactly.
bonds, the currencies move around the stocks, yeah,
Exactly.
more than
And
the
so
bonds.
a lot of times you can actually you can get the double whammy where you can actually look for both the FX benefit and the equity benefit. But generally, yeah, like when we've looked around the world, we've basically seen that yeah, the US has done well, like it has done well, but there are other places that we think are particularly attractive right now. Like we're starting to see a lot of signal strength pulling up in the UK, which is interesting because it's primarily a value play. We've had a lot of signal strength in China, but we've actually seen, begun to see a lot of that kind of subside. And more recently, we've actually started to see the US begin to tick up, which is consistent with our whole business cycle theme. And so, yeah, I think the theme of this year is that to be really successful this year, you needed to have that international diversification. It's not like it was perhaps in the 2020 to recent where you could just look at the US equity market, call it a day.
And how much of these signals are momentum versus value, which I think is kind of mean reversion, so the kind of somewhat the opposite of momentum or trend following, and carry, I guess, which is also value.
So we typically what we want to have balance to those things, right? So like uh, the first answer is one by three of each one, right? Like that's the first answer. But over time, we tend to have a pretty dynamic kind of profile in terms of what we look for. So the big drivers are always going to be something like carry, where we know that okay, these assets are particularly offer particularly attractive carry relative to the other ones. So the starting bias that we have is that hey, like U.S. assets are pretty overvalued, but if we're getting good earning signals, leading indicators are looking good, momentum is looking good, prices are locally cheap, we might load up on that exposure from time to time. And so we try to have a balanced exposure over time to those things, but at any particular point in time, depending on what the mix of conditions is, we can load on any of those factors. I think that when we look at this year, we have generally been riding like a global beta wave, right? Like if you look across the world, barring the US, particularly around Liberation Day, like you basically have had very, very strong conditions for global beta. So we basically, had close to like 200% exposure across global equities over the last few months, which has come down a lot more recently. And so I think that when you have those types of moves, it's basically indicative that hey, like you're not playing for little differentials between countries. It's not China versus US or US versus Singapore or whatever, right? What it really boils down to is that all of beta is moving consistent with each other, which is basically telling you that hey, like the entire globe is pricing in a rising growth environment and rising nominal activity environment. And so I would say that generally, like the big takeaway in terms of what's driving it is like you had a synchronized global trend, and in beta, a lot of that trend has begun to kind of slow down now.
Uh, Thank you. What you also track liquidity, so looking at reserves, repo, the treasury market, and collateral values. What are you seeing there?
So on the liquidity front, I think it is remarkably boring. So there are a few things that you need to track to basically have a good picture of what's happening in liquidity conditions. I think the big two are basically like what's happening to volumes in terms of reserves and volumes in terms of repo activity, right? Those are basically like good indications of the total fuel for financial activity. When we look at those measures, reserves have basically flatlined. There's nothing happening in reserves at all. Like if somebody is really excited about reserves, it's because like they don't look at much else. Um, Reserve activity is basically flatlined. Repo activity, on the other hand, particularly private sector repo activity. This is not including the Fed's RRP facility. Private sector repo activity has been for the last 3 years just absolutely gangbusters, which is really underwriting a huge amount of risk. Then what
Well,
you
you say underwriting risk, and sorry, but you say underwriting risk, and in a sense, they're mostly I see U.S. Treasury securities and mortgage-backed securities, and those do have risk, mark-to-market risk, and I guess there is a theoretical risk that Fannie Mae won't pay you back, especially now that it could and likely is going to be reprivatized. But it's not. Are you seeing a huge growth in repo funding? What we would actually consider true credit risk behaviors, like credit card receivables being bundled into an asset-backed security and then that being funded in the repo market as well? Because that's not what I'm seeing, at least on the charts you sent.
So there's the total amount of repo, and there's what is the collateral being pledged to
Yeah.
to do that repo, right? We don't know what the end source, like what the end receiver of the funds is. We know what the collateral is, and so the collateral that's primarily being used for these repo purchases have always been treasuries and MBS. Like that. That's even during a pre-financial crisis kind of period, that's always the collateral. Now, an important part about that collateral is basically like, is the collateral drawing down or experiencing a high amount of volatility, right? Like that's a really important consideration because the haircuts on the repo rise, right, when the volatility of the collateral rises a lot. And what we're basically saying over there is that okay, like MBS and bond vol have come down, and so basically you're looking at a situation where financial conditions are super loose, right? Like there's ample repo, you have a decline in bond vol, and there's not really much happening with reserve activity. So like the financial system is basically in aggregate very well lubricated, and you can see that also in short-term spreads, right? Like in a variety of short-term spreads. So you can look at SOFR spreads, you can look at commercial paper spreads, you can look at a variety of short-term spreads to basically gauge what's happening. So I would basically say that like there is no signs of impending financial system doom from that perspective.
I appreciate that. Oh, well, people can find you, Aahan, on Twitter at Aahan Prometheus, and your company, Prometheus Macro, is on Twitter at Prometheus Macro. Aahan, thank you again. Thank you, everyone, for listening. Please subscribe to the Monetary Matters YouTube channel and leave a rating and review for Monetary Matters on Apple Podcasts and Spotify. And by the way, I got to say, people listening, I know the numbers. I know there are a lot, a fair number of people listening to this show, but no one ever leaves reviews. And I also have retention data, so I know that people listen to the end. And so please actually do it. It really helps the show. And thanks again. Until next time.
Hey, talk soon.
Thanks for watching. As a reminder, this episode of Monetary Matters is brought to you by SMH and SMHX by VanEck, two complementary or standalone semiconductor ETFs that give investors targeted access to the full spectrum of AI's growth engine, from manufacturing muscle to design dominance. Go to vaneck.com/SMHJack and SMHXJack to learn more. Until next time. Attention Monetary Matters listeners, there is a way you can help the show. Max and I are better trying to understand our audience for Monetary Matters as well as his show, Other People's Money. We created a poll asking if you're a professional investor, are you a retail investor? And this is really going to try and help us better understand who you are. So please click the link in the description. It's only 8 questions, all multiple choice. You could probably do it in a minute or less. Really helps the show. Thanks.
Thank you. Just close the door.